Hi, so today the plan is to go over the earnings reports of the 4 oil tanker companies that I personally own. And more importantly, I want to see if the oil tanker thesis is still holding up. Now, if you haven't invested in the same oil tanker companies as me, well, that's totally okay, because this will hopefully give you a bit of an insight into how the industry is going as a whole. So the companies that I'll be going over today are Euronav, DHT, Teekay Tankers, and Diamond S Shipping. Now, if you haven't watched my previous videos on the oil tanker industry, well, I highly recommend going back and watching those maybe before you even watch this video, because it'll give you a bit more of a feel for how this industry is going and what it's like to invest in the oil tankers. Okay, for those of you who don't want to go back and watch those, let me summarize it as best I can without going into too much detail. So the first thing to point out is the oil tanker industry is cyclical. And what that means is that the companies go through waves of making a lot of money and not a lot of money. Now, this is based on many different factors, but generally it's about the supply of ships there are on the water and the demand for oil in the world. I normally don't like cyclicals because you don't get generation-long growth, but there is a rare occasion where a cyclical play is a good move. Now, the next point of this thesis is the supply of oil tankers are at decade lows. Now, this is a graph of product tankers. There are lots of different types of oil tankers, but the general trend is the same across all the tankers. And what this graph is showing is that new orders of oil tankers is at decade lows. And it takes at least 18 months, if not longer, from when a company orders a tanker to when it is on the ocean. So here we can see that the new supply of ships is getting less and less. The next thing we should note is the fleet is aging faster than this supply of the new ships. Now, the percentage of all the ships on the water is getting older, and in the next 3 years, it is expected to make up a larger percentage of the overall fleet. Now, this isn't one company specific. This is actually industry-wide. And a ship only has a lifetime of about 20 years before it is generally sold for scraps. So basically, the thesis is that when oil demand returns to normal levels in 2021 or 2022, there will be a tight supply of oil tankers on the water to handle this demand. And because of this tight supply, well, the oil tankers, they can generally charge higher rates. So if they can charge higher rates, it means the businesses make more money. And as shareholders, we also get to receive some of that money, either as dividends or as the company, say, paid down debt or doing share repurchases to increase our value. So the cycle for the strong tanker shipping rates is expected to start sometime in 2021 or 2022, whenever the demand comes back to normal. But until demand gets back to these levels, well, it is expected that the rates are going to be significantly lower. Again, go back and watch my 2-part series on the oil tankers where I go into this in far more detail. Oh, and make sure to subscribe to my channel because I will definitely be doing more tanker updates in the future. Now, because of the current low demand throughout the world, it does mean that rates right now are low. But actually, all of the companies that have reported their Q2 earnings so far have all said that the rates are holding up reasonably well, considering the time of year. And this is because historically, June, July, and August are the weakest times of the year for the oil tankers. So the short term is actually very unclear, and there could be some wild swings in both the tanker spot rates and in the share prices of the companies themselves. Literally every CEO that I've listened to speak about their Q2 earnings, well, they've all said the same thing, and they've all said that the future is very unclear, the short-term future. See, if a vaccine was to come out, well, the world might explode back to life, and every industry might be playing catch-up. Well, as an investor, I wouldn't want to be on the sidelines and miss out on this. But on the other hand, there could be a serious second wave, and the world might go back into a serious lockdown. Look, I have no idea, and anyone who thinks they have some sort of idea, well, they're just guessing. So this has to be thought of a 2 to 3 year investment to let the thesis play out properly. So my advice would be to try not to check the prices every day because it'll just stress you out. All right, now let's go see what's been happening with Euronav. Okay, so firstly, I'm just going to make an effort to not repeat myself for every company, because basically what happened over Q2 for every company across the entire industry, across all the different segments, is that the rates were really strong. Now, what I'm talking about is the average over the 3 months, because April was significantly higher than May and June because of the floating storage problems. Okay, so earnings per share came in at $1.21 a share. Now, I want you to think about this for a moment. See, you can buy shares for about $10. Which means Euronav, in just a 3-month period, made about 12%. Now let's go compare that to, say, Amazon, which has seen their share price dramatically rise because of their results. And they had amazing results. And Amazon had an earnings per share of $10.30. And you can buy shares at $3,000. So that's a return of 0.3%. So stock market wide, everyone was raving about how amazing the Amazon results were. But as a comparison, well, Euronav, and all the tankers for that matter, were significantly better. Okay, before everyone comments and says that I can't compare Amazon to Euronav because one's a growth company and one's a cyclical, look, I get that, and of course, Amazon is the better company, but right now, for Q2, pound for pound, Euronav had a far better quarter. So about 50% of their fleet have already booked rates at $60,000 a day for the VLCCs and $38,000 a day for the Suezmaxes. Now this means that Q3 is already going to be pretty good. For reference, about $15,000 to $20,000 a day for a VLCC is a break even. Now Q3 will go nowhere near the Q2 results, but it will be solid just because of these already booked orders. There was nearly $200 million returned to shareholders through $100 million of that in share buybacks and $96 million of that in dividends. So Euronav is committed to returning 80% of their profits to shareholders. So this is great, especially those share buybacks. Now, the dividend is really large, which is actually a bit annoying because most people are going to get taxed pretty significantly on these dividends. Overall, these are great results from Euronav, and I really like that a lot of Q3 has already been booked in at pretty good rates. Now, I have slightly increased my intrinsic value of Euronav from $18.80 to now $20. Now, this has changed because the net assets of the business has changed because obviously they've done all these share buybacks, therefore the value of our shares has become a little bit stronger. And look, the dividend, I'm not factoring into this price because that's more of a bonus because we don't get that very consistently. Okay, for DHT, their earnings per share came in at 81 cents a share. And with the DHT share price at about $6, that's about a 13% return in just 3 months, and similar to what Euronav did. So a very big quarter from DHT. Now, I think this is amazing. See, in Q3, they've already booked 75% of their fleet at over $50,000 per day. This is far above the break-even point of around $15,000 to $20,000 mark, which is typical for VLCC ships. So DHT have now paid down $59 million in debt. And in the last update I did, DHT said they were going to do this. And this is really good news for us as shareholders. So the payment of this debt has helped increase the equity of the business, and it was at $940 million, and now it's a little over $1 billion, and that's about a 10% increase. And DHT are going to pay a dividend of 48 cents per share. Now, although I don't like dividends as I have to pay tax, this is a monster dividend. In the last update, I did say that a surprise dividend was probably going to come our way, and it has. So the share price is $6. So that is an 8% return in cash from a quarterly dividend. And I think if you are an investor before the 25th of August, well, you'll get this dividend. And that's pretty cool that you could invest before this date and get 8% back very quickly. Overall, great results from DHT, and like Euronav, I'm just really impressed with the amount of bookings that they've already scheduled in for Q3 at high rates. Now, I've also slightly increased my intrinsic value of DHT. It was $12, now it's $13.50. This is because the equity of the business has improved. And again, I haven't factored in the dividends because I'm seeing this as just a bonus. Oh, and by the way, I often get asked which of the tanker companies is my favorite. Well, DHT, they're my favorite. Okay, now for Teekay Tankers, the earnings per share came in at $2.39 per share. Now, using the same idea as Euronav and DHT, this is a 16% return on the current share price of about $15. Very impressive. But the analysts were expecting more from Teekay, and the share price has fallen 6% on this news. It's funny how analysts' opinions can affect great results in a negative way. Teekay also paid down $180 million in debt. Now, I love seeing companies use their cash to pay down debt. This will see the book value increase, just like DHT. Now, Teekay Tankers, in their conference call, they talked about weaker rates. And this is the other reason I guess the share price dropped. See, Q3 is showing far weaker rates than Q2. Teekay had only about 25% of its fleet booked at these good rates for Q3, so they're going to have a weak Q3 in comparison to Euronav and DHT. But the guidance for the medium term is in line with the thesis. Teekay reiterated the thesis when they talked about this graph in their Q2 presentation. The order book for the industry of new ships is about 140 ships right now, but there are more ships aged over 15 years. See, when a ship is over 15 years, it becomes significantly more expensive to run, and the companies, they don't get the best rates for these ships either. Now, with the repayment of a lot of debt, Teekay were able to increase the net asset value of the business to $28 a share. See, net asset value is similar to tangible book value. And what that means is if Teekay were to sell all of their assets right now and pay off their remaining debts, well, they would receive $28 a share for the shareholders. Yes, that's right. Just the net assets of the business is worth $28 a share, but you can buy it right now at $15. So these are solid results from Teekay, and I'm most impressed with the down payment of so much debt. That's really good for their book value, which has increased by about 10%, similar to DHT. Now, I've actually readjusted my intrinsic value substantially down for Teekay, and let me explain. It was mostly because previously when I was calculating what I thought the book value could reach for Teekay Tankers, well, I think I was just being a little bit too optimistic about it. So I've decided to be a lot more conservative, and I think the intrinsic value now of Teekay Tankers is about $40. And I've based this calculation on the current net asset value plus the future earnings. The earnings per share for the quarter for Diamond S Shipping was $1.14 per share. Now that's about a 13% return for the quarter, with the share price at about $8.50. Now that seems like a very impressive result, but just like Teekay, well, the analysts were expecting more, so the share price has fallen. Diamond S Shipping, in a similar way to Euronav, have got about 50% of their fleet already booked in for Q3. But the rates that Diamond S Shipping got were lower than what the other tanker companies were getting. Look, it is still good news and there's still plenty of profit being made. It's just not as good as Euronav or DHT. Now, Diamond S Shipping were able to pay down some debt in the quarter, but it wasn't as significant as some of the other companies we've looked at. Now, although the future is hard to predict, well, the guidance and attitude from the CEO was that they're preparing for some short-term tough conditions. And probably this is part of the reason the stock price fell on the report. Now, their partnership with Norden has been actually really difficult to get exact details on what this means for Diamond S Shipping. So unfortunately, I'm still digging around for information on this and I'll hopefully have it soon. Now, Diamond S Shipping, well, they didn't press as much as the other companies, but they still had good results for the quarter. Now, like Teekay Tankers, I have significantly readjusted my intrinsic value for Diamond S Shipping. I've just realized I really needed to be far more conservative with this company, and I've put the intrinsic value now at $32 a share. But look, even though I've readjusted Teekay Tankers and Diamond S Shipping down, well, it's still so much upside on the current share prices. See, what I've done with both these readjustments is I've taken today's value rather than factoring in the future thesis. So if the share price was to shoot up to say $32, well, I think I would happily sell because that's where its value is right now. But that's very unlikely. And what I see happening is as this thesis plays out over the next few years, well, I'll be revising the intrinsic value higher and higher. But maybe over the next few years, we do get an intrinsic value of $70 because as the business improves because of the thesis, well, the intrinsic value will improve as well. All right, so what we looked at today was that Q2 was a big quarter for all the tankers. They all improved book value. Debt reduction was a key component for DHT, Teekay Tankers, and Diamond S Shipping, whereas share buybacks was more the focus for Euronav. And as a bonus, well, there were big dividends from Euronav and DHT. And Q3 2020, I think, is going to be far better than Q3 2019, just because of all of the rates that the companies have already locked in. But I think it's going to take a lot more time to see this thesis play out in a big way, because really we need the world to be in full recovery mode and the demand for oil to be back at 2019 levels. Now, a big thank you for staying all the way to the end of this video. And remember, I'm going to be doing another update on this after the Q3 earnings reports come out in about 3 months' time. So make sure you're subscribed and I'll see you in the next video.